Welcome to another episode of Tank Talks, your personal think tank for all things startups and venture capital. I'm your host, Matt Cohen, founder and managing partner at Ripple Ventures. On today's show, we are talking about why Canadian LPs are starting to wake up to the biotech industry with managing partner at Lumira Ventures, Peter van der Velden, and Anthony Mouchantaf from RBCx. Biotech companies in Canada have historically sourced funding from government programs or often larger private investors down south for years, as finding Canadian investors was hard to come by. However, funds like Lumira Ventures have become one of the top performing biotech venture funds in the country, and now banks like RBC are starting to wake up to this kind of investment opportunity. On today's show, we asked Peter to share his views on the investor journey he had to take when he launched Lumira in 2012 after spinning it out of MDS Capital, and the uphill battle he faced when trying to convince the country's biggest institutional investors to back him. We dig into the recent rush of IPOs in the biotech industry these days and how Peter sees the markets playing out over the next few years. We also get Anthony to explain why RBCx decided to finally back Lumira's newest $200 million fund in our country's largest life science venture fund after almost 20 years of not investing in the biotech space. Finally, we asked Anthony to share what RBCx is hoping to gain from partnering with venture investors like Peter and Lumira and what other opportunities they are considering next on the investment side. But before we get started today, I wanted to share some exciting news for all our startup founders out there who are selling to the enterprise and probably getting lots of questions around their company's security posture. For anyone that is lucky enough to be part of building startups, we've all seen that mad rush to answer extensive security questionnaires and implement SOC 2 controls the moment that big whale of a client is on the hook in order to not lose that deal, which unfortunately ends up swallowing the entire organization's time and resources in the hopes to land that whale, right? Lucky for us at Ripple, we have partnered with compliance automation provider Drata. Drata saves our portfolio companies from these same issues when it comes to effectively proving a strong, ongoing security posture and achieving frameworks like SOC 2 and ISO 27001. Drata allows startups to put security and compliance on autopilot. Companies using Drata experience an average time savings of 85% when compared to running the SOC 2 process manually. Build trust with customers by proving your commitment to security and maintain continuous compliance in between your audits. Don't take it from us, Drata works with all kinds of startups like Clearco, Lemonade, Full Story, Slice, and countless others. They're backed by top venture funds such as Octa Ventures and GGV and are currently G2's #1 ranked cloud compliance software provider for customer satisfaction. Listeners of Tank Talks can get set up with a demo of Drata and take advantage of a 15% discount offer and waived implementation fees by visiting drata.com/Tank Talks to get set up today. Now let's get into this week's episode with Anthony Mouchantaf from RBCx and Peter van der Velden from Lumira Ventures. Thanks for joining us in the tank today, Anthony and Peter.
Great to be here.
So, as I mentioned, today we have two special guests joining us in the tank. On the limited partner side, we have Anthony Mouchantaf from RBCx, and on the investment side, we have Peter van der Velden from Lumira Ventures to discuss why Canadian LPs are finally waking up to the life science investment opportunities. For those that might have missed it, RBC recently announced their first investment in our country's largest life sciences venture fund in almost 20 years, which is kind of hard to believe. I'd love to kick things off with you, Peter, sharing your experience in trying to convince LPs about why the life sciences industry was a great place to invest over the last several years, and how your journey betting on the biotech industry in Canada started out, and how you survived so many uphill battles.
Maybe I'll jump to the end and then we can backspin. So look, you've been doing this as well. You've been fundraising in the ecosystem for a long time. There's a couple of things that always matter, right? History and performance matter. So when we came into the fundraising process this time, we had both of those things, right? We've been operating as Lumira Ventures now for a decade. We've had, 3 funds under our belt. Those funds have done extremely well. I believe our fund 2 was the first fund in Canada to return 100% of our VCAP commitment. So, there's just a lot of track record to leverage there, which I think, just helps from an engagement point of view. Second thing, I think that really helped in terms of engaging people around life sciences was, unfortunately, the pandemic. You went from a scenario where generalist investors, really knew nothing about the space, right? In the IT space, people can think they know a lot about their iPhone and technology and all that stuff because they're using it and it's in their hands every day. 2 years ago, that wasn't true for most people. And now that's fundamentally different. There's not a single person that probably, doesn't know a lot about vaccines, has had a vaccine recently, isn't talking at cocktail parties about vaccines and vaccine development and what it means, and are they going to get a booster shot, and why would you get a booster shot, and who are the leaders, and how did Moderna go from being a nowhere company to one of the biggest biotechs now in the world? How did Pfizer put another $30 billion in earnings on their ledger? Everyone's talking about that, and so that engagement I think really helped us as we went out to reach out to new investors. And we added 24 new LPs to this fund based in 7 different countries. So that knowledge and insight was part of it. I'd say the other thing, that the pandemic did was provide better access and efficacy. We spoke to about 300 investors in this process. And the reality was I could do a call in Europe or in the UEA in the morning. I could talk to North American investors in the afternoon, and I could talk to investors in Australasia and Europe in the evening. And we would have never done that in a traditional fundraising process, right? So, I think all those things came together. And then obviously the sector has had 10 years of really strong performance. So those are the drivers behind, I think, why we got much broader engagement. We got, international engagement. We got more strategic engagement, really across the entire spectrum.
Yeah, I mean, it sounds like everyone and their grandmother realized what mRNA was over the last couple of years and became a virologist overnight. But take me back like 10, 15 years ago when you kind of were starting out making bets in this space. Who were the people you were even having conversations with? And did people even understand what you were betting on in Canada at the time?
Yeah, so the answer is, for the most part, no. There's been a couple of legacy of investors of ours who I think have understood the space and stayed with us and been through that and really are committed to the space. So if you look at groups like the FSTQ, they've been with us now for almost 2 decades in some form or fashion. They have an in-house team that is dedicated to investing in healthcare. And so they've been a very, very strong supporter. The BDC has always had a life sciences strategy. And so again, early on, they were a very strong supporter of ours. And then groups like Terralis and Northleaf, again, Terralis got funded, by the Quebec ecosystem. And you've got a partner there, Cedric Bisson, who again, made it his focus to understand healthcare. And then the Northleaf guys, Ian Carey really, built a franchise in supporting us as well. And so those early supporters were a very small community, heavily supported, I would say, by government-related programs and initiatives, but they've stuck with us. All of those guys that I've just described with us have been with us every single fund, and they bought into our vision. They bought into the team's, vision of what we could do. And as we'll talk about, we built some pretty transformative companies out of those early funds.
Yeah, absolutely. And we're definitely going to talk about some of those huge successes that have come out of those early stage funds. But as you mentioned, typically a lot of biotech companies had to source funding from government programs or often larger private investors down south, as finding Canadian asset managers to invest in biotech was hard to come by for a long time. Anthony, I'd love to hear how you were able to convince the team at RBC that it was time to start thinking about this industry more seriously as LPs.
Thanks, Matt. So first and foremost, we've been committed to the space for a long time. We have made fund investments in the life sciences in the past, albeit in sort of isolated circumstances. I think what's unique about RBC is that we've built a pretty deep bench over the years across the organization, right? So you have a global healthcare and life sciences investment banking team, and you have dedicated life sciences specialists on the banking side. So we feel that we've built enough expertise internally that gave our investment committee the sufficient comfort, let's say, to move forward on these life sciences investments. But I think what you're seeing now is a more dedicated and deliberate push into the space. And I think that's really colored by a recognition and appreciation of the kind of tailwinds that the industry is seeing, as Peter just alluded to, and the potential that we're seeing down the road.
Yeah, that makes perfect sense. I mean, I worked at RBC for almost a decade, and I remember living in Toronto, New York, how sophisticated our banking teams were on the capital market side. But that was for the later staged healthcare industry, biotech industry, the go public transactions. But this early stage investing at the LP level, was that hard to convince internally at RBC, or are they already sort of coming around to it and the pandemic just pushed it even further?
I think the pandemic certainly played an important role in, bringing the life sciences and biotech to the forefront of everyone's minds. And I think it's created, or let's say it's reminded everybody of the centrality of life sciences to the innovation ecosystem and to, any kind of innovation over the next decades. I will say, frankly, that Peter and a few other funds did a lot of the heavy lifting over the past few decades. And frankly, they've built a track record that would allow us to take a look at these funds, see decades of experience building companies, accelerating companies, and establishing a long, successful track record. So that kind of institutional history is something that would, very naturally give us the comfort to move forward. I think the risk profile with life sciences businesses are just completely different than what we see on the software side. Namely, the life sciences tend to be binary as opposed to incremental. And of course, there's a certain technical and operational grounding that's required to intelligently operate in the sector. What I will say, though, is that the ecosystem at large in Canada has developed a talent pool and an expertise over the past few decades that made us very bullish. And I think that, frankly, brought us to the conclusion that there's a lot of low-hanging fruit from an institutional returns perspective. And I think we feel very strongly that the level of talent and fundamental academic research coming out of Canada isn't translated one-to-one into commercial traction. We think there's a gap there. And so working very closely with funds like Lumira is what's allowing us to participate in what we see as being a significant upside in Canadian life sciences over the next decades and beyond.
Yeah, I mean, it sounds like Peter served it up on a platter, basically, after pushing that boulder uphill for 10 years to make it easy for the committee at RBC to approve the investment. Right, Peter?
Yeah, I'm going with that. Yeah, for sure.
Now, Peter, you've said that if it wasn't for Quebec-based pension plans, Lumira wouldn't exist. And your partner also said that it was puzzling that you guys, why no other Canadian institutions seemed to be a bit more interested in this asset class earlier on. So in your opinion, Peter, what has changed recently besides the pandemic to make these institutions start waking up to the asset classes? Is it purely returns-based?
Yeah, look, I think it's multivariable, and I can't talk about investors as one class of investors, right? I think of the world as really four classes of investors. So I look at strategics like RBC and Alexandria Properties and our pharma partners who came into the fund. And obviously, they're motivated by returns and strategic objectives, right? And so we can offer them something unique around their strategic objectives. I'll let Anthony talk about RBC, but if you look at our pharma partners, this is our second co-investment fund where we brought in a pharma partner with a specific set of objectives, and we get to leverage all their insights and all their knowledge, and they get to leverage all of our deal flow and connectivity and the fact that we can co-invest and build companies so that their BD teams can actually engage at a later point in the cycle and hopefully acquire or partner with those companies. And so at one level, it's all about returns and strategy. At another level, there's an investor group, and I'd say this is like groups like Van City and our family offices who are investing really for both returns and impact. Look, and what we do is unique, right? There's no other part of the venture ecosystem where what we do results in changing people's lives, right? We build products, we create technologies that meet unmet needs, and when we do that correctly, the result is products that people use to manage their health or to change their health fundamentally. So that's a completely unique driver. Then there are a bunch of investors who are completely return-centric, and that's okay. Look, that's great. We're happy to have those kind of groups, and that, some of our fund-to-funds are those kinds of groups where it's really, principally about returns for them. And then if you talk about sort of the Canadian pension ecosystem, I kind of described it in three pools today. Look, there's the Quebec-based groups like CDPQ, FSCQ, Fonds d'Action, who've been in the space for a long time and see life sciences as a core part of the innovation ecosystem. And they want to support Quebec companies and obviously Canadian companies within that continuum. So they're very engaged partners, and they've been doing it for a really long time as part of a total venture strategy. There's another group of pension plans today who are doing what I call late-stage crossover in the space, and I think it's really a public market strategy. I don't look at it as a private company strategy, right? These tend to be very big deals, $100 million deals. They tend to be companies that are pre-IPO. And I think they're agnostic as to whether they're Canadian or European or Asian or whatever, right? It's really part of a public market strategy, and how do you get exposure to that? And then, unfortunately, there's a bigger part of the pool where many of the pension plans in Canada today are quasi-private equity firms, right? You can say it ain't so, but it is, right? Like they're private equity firms, and so now they're allocating assets to their internal teams, and they're thinking about where they want to deploy capital within their internal teams. And because their internal teams don't have any expertise in healthcare, and particularly in private healthcare and early stage healthcare, it's challenging for them to allocate capital to this sector. So, as part of our process, we talked to many of those pension plans. I think they're all thinking about it. They're trying to figure out how they play in the broader continuum. But, it's challenging for them to allocate capital to a sector that they don't have any internal competencies in today. Or for the most part, they don't. Some do. But for the most of them, they don't have this as a core part of their strategy yet.
Yeah, I mean, it makes sense. CPP, the largest private equity fund in the world, invests predominantly in airports and highways, infrastructure stuff. But investing in biotech, not only is it extremely risky, but it's also a really long-term bet. So I'm also curious how the family offices were able to get their head around it if they were not maybe operators prior to investing from the biotech space into a firm like Lumira? How did you convince those groups to be, seeing what you were seeing in their outcomes?
I think the time frame thing is a bit illusory. So I don't think it's actually true. I think if you look at biotech liquidity, it actually beats IT liquidity. Because we, frankly, for the last decade, had the best IPO market. So more than 50% of all IPOs for the past decade have been life sciences companies. We have a very large, what I call sophisticated biotech and pharma market, which has deep capital bases. So their ability to acquire companies is extremely strong. Again, you look at Pfizer, in the acquisition they just made of $1.5 billion acquisition of a Canadian company. That's part of their pandemic profits, right? That are rolling right back into a company that they had some visibility around. So, in fact, the timeframes are shorter in many cases in life sciences. Our average liquidity time is about 5 years from investment to exit. It's not 100% across the portfolio. So we have companies that we hold longer. We have companies that we hold shorter. Our quickest liquidity event in our last Fund 3, the one just before this, was 6 months. We went in, got out, 6 months, whole time. So I think that's a bit of an illusion. And so family offices are looking at performance, total return, and they're prepared to be committed for the duration of a venture fund, obviously. And I think we can show that our time frame to liquidity and returns is relatively short. Our Fund 3, which is a 2017 vintage fund, we've already had 4 liquidity events. All right, we've already distributed back a big chunk of capital, right? So I don't think that's quite the challenge it was. I think, again, as people get more sophisticated and they start to learn more about the sector, that's one of the things they're learning, is that the risk is no different. And in fact, the timeframes might be shorter.
Yeah, absolutely. I mean, let's double click on that for a second. For those of us following the IPO markets over the last 2 years in Canada, 2020 was a record year, as you mentioned, for private and public fundraising by Canadian biotech companies, including the 3 largest IPOs ever by domestic drug producers, AbCellera Biologics, Repara Therapeutics, and Fusion Pharmaceuticals. It would be great to hear from you, Peter, on how the market has matured over the last decade in your eyes, and why you think the public markets have finally come around in Canada supporting these go public transactions.
So I think the public markets have matured, but the reality is every one of those companies that you talked about cross-listed, right? They all went to the NASDAQ or they went to the New York Stock Exchange. They all went to another exchange as well, right? And why do you have to do that? Well, you need to have the institutional following and you need to have the analysts following, right? And so, yeah, the Canadian firms have all grown. I mean, RBC is a great example. Look at how they've grown their healthcare team, right? I mean, their team is now quite broad and quite deep across the entire continuum. But I think it's still pretty hard to take a company public in the life sciences space only on the Canadian exchange. I think there was one company last year that did that. That was Eupraxia, right? It was an only Canadian listing. That's still rare, right? So the markets have matured. They're following the momentum in the U.S., but most of those big IPOs are cross listings, and you need to do that because you need that institutional following outside of Canada.
No, that makes sense, Peter. I mean, like I said, the only real investments made by a Canadian institution into the biotech space have been CPPIB's crossover investment into Fusion and Deep Genomics. So, Anthony, how do you think larger institutions like RBC should start thinking about backing these companies from an LP perspective? And what are RBC's longer-term plans with Lumira and firms like them?
So maybe I'll start this answer by providing a little bit of empathy or a little bit of insight into how I think investment committees at large institutional investment funds think about investing generally. So keep in mind there are real deep intractable differences between biotech and life sciences on the one hand and what we would colloquially think of as tech, so software and information technology, on the other hand. First and foremost, biotech is really hits-based, okay? And it's binary. So what we mean by that is either a drug is approved or it's not approved. Either it works or it doesn't work. It either goes to market or it doesn't go to market. You contrast that with software firms that are essentially incremental. So you have $1 million in ARR, you have $100 million in ARR, and you have everything in between. And what that does is, or at least it creates a perceived risk mitigant in these investment decisions. Investment committees will always, rightly or wrongly, depending on your perspective, ask the question, what happens if this company doesn't, meet its potential, right? It doesn't hit its milestones, or for whatever reason, something goes awry. And when you're operating in an incremental paradigm, it's a lot easier to answer that question. And when you have, the kind of natural risk mitigants built into a software company's tech stack, it becomes a little bit more palatable to take or to make high risk investments in some of these more incremental businesses. Again, contrast that with a binary outcome, specifically a binary outcome where the folks sitting around the table don't have the technical backgrounds to, analyze the risks in any real profound way. And what you end up with is, a real reluctance on the part of these institutional investors to move forward on these kinds of investments. So what you're left with, I think, is what we believe is the kind of centrality of fund investing and partnering with managers to any large life sciences strategy. I think what you have in firms like Lumira is a first order diversification and a risk mitigant from that perspective. So although you're still operating in a binary paradigm, you suddenly, through a portfolio investment, have many various binary bets, each of which being vetted by, again, a team with decades of experience doing so. And so you have that built-in risk mitigant from a diversification standpoint. I think the other big benefit to fund investing in the life sciences goes back to this technical grounding. Again, just by virtue of the way institutional investment funds are staffed, you'll typically have a dearth of real sort of life sciences, biomedical expertise sort of on staff. And what a fund investing strategy allows you to do is to essentially outsource that expertise and work with third parties who you know and trust. So, in a sense, it's not quite a pure diversification, but it's certainly one way to get exposure to the asset class without having to build in the sort of internal team and without having to make decisions that you're not necessarily entirely comfortable with on your own. So when we think about big institutions thinking about investing in the life sciences, I think partnering with GPs like Peter and like Lumira is really a central sort of cornerstone of any strategy.
No, that makes a lot of sense. It sounds like anyone who has any sniff of a business degree or business background could go out and become an enterprise SaaS venture investor, just to shoot myself right in the foot. But if you really wanted to go out and invest in what Peter's doing in the biotech side, you basically are going to end up like Henry Kissinger and Theranos if you haven't done it the right way, or any other sophisticated investor would. So it sounds like it's almost like an R&D investment with a little bit of like a scout research mission from an LP perspective when you're trying to learn about this. Is that how sort of we should be hearing about it from the LP side? And Peter, can you chime in on also the way that you are pitching it to them on the same side as well, from a co-investment versus fund investment?
So here's the thing on the LP side, and I know I've alluded to this. Just being totally candid, I think MBA types and finance types who staff a lot of the major institutional investors in this country have the grounding to add value in a very meaningful way when looking at tech and software businesses. And the reason for that goes back to everything I just mentioned, is that you don't need to understand the underlying code in an incremental business to intelligently opine about things like market size and product market fit and gross margin and revenue growth and all the traditional things you associate with business-based analysis. And the reason for that is that although we talk about software and IT, again, colloquially as being tech, the reality is the fundamental risk of these businesses is primarily market risk and less so technical risk. And that's because we can pretty reliably code new apps, code new software, and bring that software to market, right? When you're faced with a software business, you're not really concerned about whether the developers and the engineering team is going to be able to build it. You're really concerned about, are they going to be able to build it in a sleek way with a nice UX, nice UI? Are people going to want to use it? And that's all something that lay individuals with a finance background can get well versed in and can opine on, very intelligently, in my view. I think the challenge with the life sciences is, although there is, market risk, and the market risk can be, significant when you get into discussions around the nuance of, insurance and payers and all that kind of stuff. You still have a very substantial, if not primarily, technical risk component to these investments. And the reality is, you just cannot intelligently analyze that without having the right technical grounding and having the right sort of academic sort of experience there. I go back to this idea that, our view at RBC, and I think this is the view taken by certainly, I think, the pensions in Quebec who have been active in the asset class, is that unless you're building out that team internally, the way to access the asset class is to partner with other funds and to selectively co-invest in what you think are breakout companies. And, funds like Terralis out of Quebec in particular, I think, have done, a really phenomenal job at that. I think Terralis alone has, first off, we've invested in a lot of the same life sciences funds, but they've also invested directly in companies like Zymeworks, Fusion, and Repair. So, between those three, you have a fund of funds that's invested directly in three of the top life sciences outcomes in this country. So it can be done. Again, our view is just that something as technically esoteric and complex as bio should be kind of done hand in glove with GPs who you know and trust.
Let me jump in there a little bit, because so first of all, I agree with almost everything Anthony said. But one thing I would say is, look, our business is way more than just the science, right? Like when we're making a bet on a company, we are doing market due diligence. Is this a product that's going to make a difference? Can we get it reimbursed? Where's it going to get uptake? What's the competitive profile versus everything else that's in the pipeline? Who are the right KOLs, key opinion leaders that we need to engage with to figure this out? So the science, the biology of the entity is one piece of the equation. We need to be convinced that the science is fundamentally great science. But we spend as much or more time on all the other stuff, right? If we win, because the worst thing you can do is you win on the science and you lose on the market, right? Because if we don't have a company that's commercially viable, then everything we've done before is a complete waste of our time. So I think that's part of the equation. I think the other thing that Anthony talked about, which is really true as well, I think there's a continuum opportunity here, right? When we do an investment in a private company in a space, what we understand is the entire continuum of science going on in that space, from public companies to private companies, the entire breadth. And so what we're starting to see is, the smarter firms are starting to partner with guys like us because they want to leverage that for their public market strategies and figure out, hey, if these guys have invested in an NK killer cell company and they've done it at a private level, what does that mean for the opportunities in the public markets, and how do we leverage that and participate in that sector? So I think that's part of it. The other part, when you talk about risk in the space, and this is something we spent a lot of time on as a team, it's all about portfolio architecture, right? I'm not looking to build out a portfolio that's all 10Xs and it's all binary risk, right? We actually build a portfolio that has a bunch of companies that we think could be 10s or more, a bunch of companies that could be 6s, and a bunch of companies that could be 3. And each one of those has a different risk profile associated with it, right? And if you look at our portfolio and where we win and where we lose, the real process and the real art in our business is making our bet and then being really disciplined about whether we allocate more capital to that bet or stop allocating capital to that bet. Because what I want to do is win on those companies where I've deployed my full allocation, $10 to $15 million against that. And I want to lose on companies where I've only deployed $1 to $5 million, right? If I'm doing my job and I'm managing the portfolio, that's how I mitigate the risk more broadly. And so I don't get that binary outcome. I'm winning on big numbers and I'm losing on smaller numbers. That doesn't mean that occasionally we won't lose on big numbers too. That can happen. The other thing we can do is we can monetize our companies long before we know the answer, right? I don't need to know if the product gets phase 3 approval most of the time, right? I can monetize my company based on, and sometimes phase 1 data, sometimes phase 2 data. long ahead of that. One of my partners used to have a saying, I'm in the business of never knowing the answer. Well, I'm not sure that's 100% true, but that is part of the equation, right? That's all about risk. When do we take our chips off the table within that continuum of value creation? And when do we let other people in the ecosystem, whether that's pharma companies or other partners, take a different amount of the risk that we're not prepared to take anymore because we've done the part that we want to play in and we've had the value creation cycle that we wanted to participate in.
I absolutely love that. Win on the science, lose on the market. I mean, that's what you get paid for, Peter, to be a professional money manager. We have the same saying at Ripple, which is like, this can be an amazing investment, a terrible business like Uber, or it could be an amazing business, but a terrible investment. And it could say the same thing about this biotech, science space with what you're doing. And so I totally understand where the value add comes and where separating the science from the market and the business is really where the value add comes also from being investors in Lumira. But look, Peter, you recently closed on a materially oversubscribed $200 million US fund that included a number of strategic and corporate investors in Canada, the US, Europe, and Asia. But what do you think needs to happen in order to get more Canadian institutions and family offices comfortable with making large investments in the biotech space?
Yeah, so actually, family offices were fantastic participants in this new fund. In fact, they're the single largest investor group in the new fund. They account for just about 25% of the fund. So I think family offices are getting it. We found the engagement with family offices fantastic. They love the idea of making a difference with their capital and getting a return on their capital. I think that really drives them. So the combination of high impact and high performance really resonated. So, and I'd say across our family offices, it's a really entrepreneurial group of people who understand what it takes to be an entrepreneur, what it takes to be a value creator. And, I'd say most of our family offices, not only came back, but doubled up. And we added, I'm going to say probably a dozen new family offices in this fund. So, that part I'm not worried about. And I think there's lots of growth opportunity there because if we can deliver the kind of returns we're delivering and keep up that engagement on impact and performance, I don't think there's an issue. Look, on the institutional side, this is a huge market. Like about between 160 and 200 billion is going to go into innovative healthcare this year, right? And so, as a Canadian, I think it's tragic that many members of the Canadian ecosystem have not participated in that. I just think that's a real loss, right? And so, I think at the end of the day, what's going to drive that is performance. If you go back to Mark Wiseman's comments from 2005 when he took over as CEO of CPPIB, the whole argument was at that time, venture hasn't made money, right? That was his argument. And in 2005, he was right. The venture asset class in this country had performed abysmally, right? Like it just hadn't worked. Roll forward, 5 years, we started to change the ecosystem. New players come into the ecosystem. We started to have new sources of capital. Now, a decade later, this is going to be a, $10 to $12 billion business this year, up from, $1 billion a decade ago. And I think, you're seeing performance across the entire continuum, right? Not just life sciences, across the entire venture continuum. And then for us, again, I think it's about fantastic IPO liquidity, M&A liquidity. And I think this growing awareness that life sciences is here to stay and it's a high impact part of the market. And I think the other thing, it's interesting, another former CEO of CPPIB, Mark Manchin, said this in 2018. He talked about the fact that CPPIB needs to be investing in innovation in this country so that they're creating the next generation jobs that are actually going to put money into the pension plans that exist in this country. It's kind of a nice equation, right? Create jobs, people pay pensions, they have more capital to deploy. Now, I think that that's part of the realization. If we're going to create a next generation economy in this country, life science is a big part of it, right? We spend about, depending on the province, between 40 and 50% of the revenues that come in a province is spent on healthcare, right? So we need to embrace what we're doing in healthcare. We need to make this a strategic asset, and we need to make it part of our innovation economy. And I think, that's what's going to drive engagement.
Isn't that the definition of an ecosystem, right? Like the money going into investing in airports or, highways. I don't see a lot of innovation really happening in the airports these days, but the money that CPP or these pension funds or institutions can be investing in the human capital and the innovation, even if the outcomes, or as your partner says, not knowing the final answer even comes around, there's still going to be IP that's generated, innovation that's created, and hopefully it will get to the right answer that you bet on 10 years prior. But it takes some of these larger institutions to see that long haul, which RBC is obviously doing as well. But let's talk about some of those returns, Peter. The Canadian-based biotech venture capital firms among yourself include firms like CTI Life Sciences, Genesis Capital, and Amplitude Venture Capital, who are also raising new funds these days as well. And when you relaunched Lumira in 2012, after spinning it out of MDS Capital, you were quoted as saying you wanted to create companies worth over $1 billion in value. Well, now, Peter, you already have two companies, Zymeworks and Arena Pharma, that are given way more valuations given the craziness in the public markets these days. So are you expecting to have $10 billion valuation companies in the next fund? What are the targets for you these days?
I'm a bit jaded on the whole private company unicorn language because it feels a little bit contrived to me, right? You see a lot of these unicorn companies that have $1 billion valuations and they have $1 billion of capital deployed. Well, that doesn't really get me very excited, right? For me, it's about what really matters to our investors, right, and to our stakeholders, and it's about creating companies that build transformative science. And it's about companies that deliver tier one returns. So if you look at the past 2 years, we've had 6 what I would call high value liquidity events. Half of those are in unicorns, $1 billion plus companies. Half of those are in companies that are nowhere near that, but still generated a 6x for us. So that driver per se isn't what's driving me. The other issue in the biotech space that I think is unique compared to IT is that if you look at both Zymeworks and Aurinia, we took those companies public long before they had $1 billion valuations, right? In fact, we did Aurinia as a pipe when it was a $20 million valuation, and we did even when we took Zymeworks public, I think it was a $300 million valuation or thereabouts. So the art in investing in those companies was not about getting them public. It was about having a vision and a strategy for how that capital that we raised in the public markets, which, by the way, is less expensive than venture capital and more accessible, how we could use that capital to create value in our companies and to make sure that we educated our limited partners that we were going to hold those positions until we got to that value. That it wasn't about hitting the IPO and selling our stock or distributing our stock. It was about using the IPO as a tool to get the capital resources to allow us to build our companies to the value. So we held Aurinia for 6 years in total and generated almost $100 million there. And we held Zymeworks for 4 years and had a really nice return there as well. But we held them for at least 3 or 4 years after they were public. And that was all part of that continuum. So I think that I get way less caught up in this unicorn thing because I don't think it's nearly as relevant in the life sciences context.
No, that makes a lot of sense. I mean, it's the opposite of the pump and dump. Yeah, you can get $1 billion valuation in the private markets, but you just sold 5% of your company and your revenues are nowhere close to that. If you went to the public markets, you'd be pretty much slapped in the face like WeWork if you try to go public. So I totally get it. Anthony, I got to ask though, you've been part of the venture community for some time now. You've had roles at OMERS Ventures prior to joining Sid and the team at RBCx. With so many institutional funds already on the list of investors in Lumira, like Case Depot, Teralis, Northleaf, Kensington, what sort of value are you hoping to offer funds like Lumira to stand out from the pack besides just the capital commitments? And how should other fund managers look at RBCx for future LP investments?
So when I get this question, typically, I like to say that RBC and, banks in general are neither pure, returns-driven institutional investors, nor are they corporate or certainly not strategically driven investors. I think banks play somewhat of a unique, very idiosyncratic role in terms of their relationship with the funds that they're supporting and that they invest in. I think if you take a fund like Lumira and some of the other funds that we work with, you're going to have sort of multiple touch points and really a very sort of multifaceted relationship from a breadth and scope perspective. So, Peter and the Lumira team works very closely with our global investment banking team out of New York. We work very closely with Lumira on the fund finance side, and we bank a majority or certainly a plurality of Lumira's portfolio companies, wherein we feel we play, an important role in accelerating those life cycles and supporting those companies to get to meet the objectives that they're pursuing. So above and beyond just providing capital, we're working very closely with these funds. And I think it's worth thinking about, who do you want to partner with from a sort of core financial institution standpoint. And I think we've built a really deep bench in the life sciences. We have a team from coast to coast who work only in the life sciences and work exclusively with life sciences companies. So we've built a deep bench on that front. And we think that we're able to accelerate the journey for a lot of the funds that we work with. I think, more generally, how would institutions or fund of funds differentiate themselves? I think it's really demonstrating that, investments in the life sciences aren't just a temporary outgrowth of COVID, and that that investments in the life sciences today represent longitudinal, long-term commitment to the space. Because I think that's a huge part of it. I think I'm certainly of the belief that when funds are performing, there's an underlying expectation that their LPs will continue to support them. As I think Lumira has put together a really terrific group of LPs that we're, proud to join, albeit, maybe Peter would say somewhat late to the party. But it's really that demonstration that investors understand why life sciences are so important and will continue to be so important over the next, I've said this before, over the next several decades, but I think life sciences is probably the internet in the 1990s right now.
That's awesome. And it sounds like pure LP GP fit. Peter's been building a track record for a long time before RBC came around to the picture. And that goes obviously a long way with firms like RBC. And we're trying to do the same thing at Ripple as well. From your side, Peter, what does it look like on a quarterly basis when you are reporting back, though, on a financial side, when there's not a lot of things to report on besides the innovation happening? How do you kind of keep up the communication with LPs that are sort of new to this investment world?
We've actually just changed a lot of our LP reporting because we're starting to recognize that a lot of our LPs don't have, the continuity of experience in the space. And so we're going with our quarterly reporting and we're expanding way beyond just what happened in our fund. And we're talking much more broadly about what's happening in the ecosystem. What are the things that are on our radar? Why are they on our radar? How do they think they're going to impact our theses and our themes that we're going to investigate? We didn't do that traditionally when it was a very small group and they all understood exactly what we did every day. Now we're taking it broader, and I think that's worked. And we just did the first one of those with the new fund. I got an immense amount of positive feedback from people who just said, hey, look, I appreciate you're going broader, right? And not spending as much time, going into every nuance of the portfolio, because at the end of the day, they get all that in our deep dive reporting on the portfolio. But really in the president's comments and the team comments, we're trying to share a broader spectrum of what's going on and why it matters to you as an investor, but also as a person, right? Like, why does this matter as a person? I mean, you alluded to, the whole Theranos thing and the bad blood situation, right? The book. And that's a great lesson in failed process, right? It's not a great lesson in failed VC process, actually. It's a great lesson in failed process, right? No diligence, getting excited about an idea, going deep on an idea. I mean, I was reading some of the trial transcript the other day. CFO says, yeah, we didn't do audited statements. Fiduciary obligation 101 of your board when you have third-party investors, right? Do audited, statements, right? So, it's interesting. Some people talk about that as being a testament against the venture. I go, it's exactly the opposite. There are no healthcare VCs actually invested in Theranos. All the sophisticated guys said, we're out. We can't diligence this in a thoughtful way, right? So I think that's part of it, right? Is just talking about those things and sharing with those things and frankly, engaging people more broadly in the ecosystem to think about how, when you come to vote, are you voting around innovation in this next election? Are you voting around engagement? Are you voting around job creation? Are you voting around a vision for how to make Canada better, right? That's the stuff that matters now. And so we're trying to share more of that across the continuum around the stuff that we know. Not trying to comment on other stuff that we don't know, but that's part of what we're doing now.
I love that. It's like getting inside your head, how you're thinking about the process. We do the same thing at Ripple. We share our due diligence process. We share our data rooms. It shows actually with Theranos how the venture due diligence process and sort of operations that they have in place to manage their investments goes above and beyond what a traditional direct investment, family office investment is lacking, and why it makes sense to be an LP and learn from the processes that people like you and I are trying to build at our firm. So that makes perfect sense. Maybe you should start a podcast, Peter. I mean, you got the voice. You should be doing.
I got you, Matt. I think we could just do this once every now and then. I like it.
All right, we'll do a quarterly investor update for both our funds over the podcast.
And I love what Peter just touched on here about, voting around engagement, voting around innovation. And I think that we maybe don't think about that enough in the context of, institutional investing. I think recall that a lot of these pensions are really managing the, retirement funds of pensioners. And I think it's a very, legitimate lens to apply to investing decisions about how, investments may impact the future of the country in a more expansive way than just the returns to the bottom line. And I think the Quebec pension funds do an exceptionally good job at that. And I think because they do a good job at that, it's not a coincidence that they're the funds that have been the most active in the life sciences space. I think, Quebec investors are really good at thinking about Quebec holistically. And I think they make their investment decision with a lens on creating new innovative jobs, on what's good for the province at large. And I think we could borrow some of that thinking across the rest of the country. I think, a major challenge is that, everyone loves to talk about innovation. Everyone loves to talk about, doing good in addition to doing well. Unfortunately, there's no barometer and there's no accountability for creating innovation and creating jobs in a very general sense. Asset managers and institutional investors aren't reporting on, in air quotes, the innovation that they're fostering quarter through quarter. They're reporting on the returns they're driving. That's somewhat unfortunate, particularly in an industry like life sciences, where if you make a successful investment, chances are you're increasing lifespans and health spans, and you're improving the quality of life of individuals in this country and around the world. And, it's a very difficult problem that we don't have a way to accurately measure the positive externalities of good investments, of which I would argue, they're a lot more substantial in life sciences than in many software businesses. And by the same token, there are no good ways to measure the negative externalities of investments as well. So that's I think certainly this isn't the topic of this discussion, but it's a huge challenge. And, I'll just, pin that by saying doing well in the life sciences very often translates to doing a hell of a lot of good. And we certainly think that's important.
No, that makes a ton of sense. Let's talk about that early biotech ecosystem for a moment, guys. Everyone knows ecosystems like Boston or San Francisco and even Tel Aviv are where some of the greatest biotech companies are getting their start. In Toronto, we had the Johnson & Johnson J Labs incubator running to help startups get access to wet lab space and Mars and CDL. And we also have the Sick Kids Breakthrough Fund, which I'm a founding member of, which is a form of venture philanthropy to help innovative ideas get off the ground and get real world commercialization. So what do you guys think Canada needs to do to compete on the global stage as a biotech leader? Let's start with you, Peter, and move over to Anthony after.
Yeah, first, Matt, thanks for being involved in things like the Sick Kids, Breakthrough Fund. That stuff is super important for engagement and understanding, right? Allowing people to get engaged in those things and understand what's going on in our Canadian institutions. I don't think we promote our Canadian institutions and the innovation coming out of those institutions nearly enough. And so those kind of things are great. And it's part of what makes our job easier, frankly, when I go and raise, capital from family offices. Because again, many of them are very philanthropic in their nature. They actually care about this kind of stuff. And so seeing that continuum is really important. I think with respect to your specific, question is, the reality is Canadian healthcare is on the global stage, right? It is, today it's happening regularly. We're seeing the late stage deals attracting capital from around the world. Again, the Pfizer acquisition of Trillium a couple of days ago, is a great example of that kind of deployment of capital. The challenge is if you look at later stage financings for Canadian companies, about 10% of the capital comes from domestic funders and about 90% comes from foreign investors. If you look at it on the IT side, it's about 50-50. So it's completely different. That's a fundamental problem because what it means is that early on, a lot of Canadian innovation that frankly, in the healthcare space, that frankly is funded by the government is immediately being controlled by foreign investors. And it's not I'm not against foreign investors. I'm absolutely happy to have it. But I think we need to have more control, and we need to share in more of the positive outcomes that come out of our ecosystem if we're going to continue to build the ecosystem. So, we're there on the global stage. We could do a lot more. So go to your specific question. If you look at a place like Boston, you've got Kendall Square, you've got the revitalization of the harbor areas, like the city's all in. City of New York. This is the city of New York, not the state of New York. The city of New York just announced a $500 million commitment to life sciences on top of their already $500 million commitment. So that's $1 billion from one city that says, I have a vision to make New York a global life sciences ecosystem. And they want that to translate into 40,000 jobs, right? So you need to have governments, federal, state, local, who have a vision and a commitment to doing something bold and brave. So then when you translate that to Canada, so we've got to stop viewing innovation in the healthcare sector as a cost center. This is a problem today, right? Everyone thinks of healthcare as a cost center. How do I contain the costs? How do I keep healthcare costs down? We don't think of it as a strategic asset. Maybe for the first time now, because of the pandemic, we're starting to think of healthcare as a strategic asset, but we haven't historically thought about it as a strategic asset, right? So we need to do that. And then when we start to think about it as a strategic asset, we can't go back to funding all the plants from the US guys and say, no, help us build an mRNA plant here today and create that rebranch, economy that we had a decade ago. We've already seen that does not work, right? So if you start to think of the industry as a strategic asset, then you need to think about how you fund and have more domestic control of that asset, right? And so I think that's really, really important. I think you need to reimburse and provide market access for truly Canadian innovation in a preferential way. I remember sitting on a panel maybe 7 or 8 years ago with a number of government people and saying that, and they said, "Oh, we can't do that because of free trade." And I said, "That's utter crap." Right? That's just utter crap. America has Buy America, slapped on everything, right? Why can't we preferentially support the adoption of best-in-class innovation into our ecosystem, whether that's digital health or whether that's med tech, whatever. If it comes from Canada, let's give it that extra shake. That's what we do even in our portfolio, right? I'm always going to give a Canadian company an extra hard look because I care about building Canadian innovation in Canadian companies, right? So, and then look, I think the government, and you're starting to see some of this initiatives, the new Vicky program is talking about having more allocation to life sciences. Life sciences has been underfunded through some of those programs. So I think you need to have more of that engagement. And then frankly, programs like in Vancouver, in BC, where you've had tax credits for angel investors, right? Those have worked brilliantly well. I mean, Zymeworks was a company that raised a lot of its early capital from angels. And then we came in and, do what VCs do. And so I think there are creative ways that don't necessarily cost the government a lot of capital, but can be highly supportive of the ecosystem. And again, maybe I just will come back to VCAP. I mean, I think VCAP is probably one of the best programs the government has ever created, right? Doesn't increase the deficit, drives a real return, and is completely aligned with creating a next generation economy. So do more smart things like that.
Yeah, we got to be more on the offensive versus the defensive, looking at it as an asset versus a liability. What about you, Anthony?
Listen, that was a very robust answer from Peter, and I don't have a whole lot to add. But what I would like to do is double down on this commentary around Vicky. I completely agree. I think VCAP and Vicky are probably two of the most successful government programs from an innovation and job creation standpoint that I can think of. And it's interesting for us because we have something of a bird's eye view of Vicky, and we have something of a bird's eye view of where those funds are flowing and the returns they're generating and the jobs they're creating and the innovation that they're fostering. And the reality is, and this is, hats off to the funds of funds who manage the Vicky funds, which would be, I'll do a shout out here to the folks at Terralis, Kensington, Harborvest, and Northleaf, but they've all done a really phenomenal job and have driven great returns on those investments. Those investments then flow down to venture capital funds, who then have invested them in who've invested the funds in great breakout companies, and obviously this year has been a really unique and standout year for the Canadian tech ecosystem. I think there's no reason why this next round of Vicky should be sub 500 million. I think there's capacity and room to grow multiples of that. I don't think it'll happen. I don't see the discussion currently centering around it, but I think that's one program where I think if we could increase the commitments from the government north of $1 billion, $2 billion, I think there's just a ton of low-hanging fruit and a lot of innovation to be created. And then Matt, in response to your question about going on your comment about going on the offensive rather than being on the defensive, I'll share a very funny comment that prominent individual in the life sciences investment space in Canada, who I hope will listen to this and laugh, but he basically described Canada as punching exactly at its weight. He said, we're not underperforming globally, but we're certainly not overperforming either. We're right where you would expect us to be from a global sort of performance standpoint in the life sciences. I think that's a very Canadian answer, and I think it's not wrong. Where I would generally disagree with that POV is that we think there's a pretty meaningful mismatch, and I've said this before. There's a meaningful mismatch between the fundamental research coming out of Canadian universities and the talent being produced at Canadian universities, who we believe are genuinely second to none, whether that's in Boston, New York, or Silicon Valley, or anywhere. We do think it's not translating into sort of commercial traction at a sort of 1-to-1 ratio. And I think there's a whole host of reasons for that. But I think, a big part of it is, I think there's a real sort of underestimation of the resiliency of the United States in a whole host of ways, but particularly, I think, culturally in a lot of ways. There's a graphic that I can't recall where I see it, but it was essentially a measure of patents flowing in and out of a country, or inventions flowing in and out of a country. I forget exactly what the measure was, but net, the takeaway is that despite, I think, grossly exaggerated tales of American decline, it's still, if you're really, really good at something, and if you're inventing something, your destination is still in large part the United States of America. And I think a lot of that really boils down to culture. And I think to a willingness to dream about building big things. This is a country that was born out of a violent rebellion against a king, and that rebellion created really two societies. It created the United States, and it created Canada, which was an outgrowth of the conservative elements of that society. And so that's intertwined into the folklore of every kind of American kid growing up, to have a certain disdain for incumbency and a certain disrespect for the man. And I think Google, Facebook, and some of these real breakout companies were, I think then only possible in the US, but I'd like to say not anymore. But I think people really underestimate the sort of cultural potency that goes into creating companies, into creating massive companies like the ones I just mentioned. And I think the same holds true in the life sciences. So, long-winded way of saying, I'd like to see our folks dream bigger. And I think that we as a country are capable of a lot more. And I'm bull on where we get to ultimately.
Yeah, I mean, I think conversations like this hopefully will start to trickle its way through the ecosystem more, and have maybe governments and leaders think about how we could be more on the offensive and not let 90% of the upside opportunities go to foreign investors, as Peter alluded to. But maybe we'll save that for another podcast, guys. Peter, I'd love to hear what's next for you and the team at Lumira, and how our guests can reach out to you if they're working on the next cancer curing formula.
PLV@lumira.vc. Really straightforward on our website as well. Look, we raised the new fund. We did the first close on the new fund in January, did the final close in July. It's our biggest fund ever. We've already done 4 investments. We're going to do 7 before the year end. That's our highest investment pace ever on a new fund. We transitioned completely seamlessly from making our last investment in Fund 3 on December 22nd. to making our first investment in Fund 4 in February, right? So the pace is unbelievable. The deal flow is unbelievable right now. I think the other thing that we want to do more of is more strategic relationships. We've done one with Merck. We've just done one with Angelini, which is publicly talked about. That was one of the pharma partners. We've got a lot of other pharma partners now starting to talk to us about how we can do more in partnership with them. And I love that model because we get all these smart people who understand our domain, who are committed to our domain. And I think we can build a really good relationship with them that leverages what we do, company formation, company building, company management, to help them, really achieve their broader strategic objectives. So that's where we're at right now. A little bit of kind of core investing and a little bit of deepening the bench in terms of what we can do for people.
No, I love that. And Anthony, what about you and the team at RBCx? How should founders and startups get in touch with you and your team?
So would love for them to visit rbcx.com. Browse the team. We list everyone on our life sciences team. So if you're specifically a life sciences company, would encourage you to reach out directly to the relevant folks in your area. And beyond that, would love to hear from folks directly. My email is, I think, on the website, and always, more than happy to connect directly with folks.
And what should startups think about when they, discuss RBCx with their friends at the poker table or at the, the startup bars when they think about partnering with firms like RBCx? What sort of things should they be aware of?
That's a good question, Matt. I'll give you the kind of 500-foot perspective. I think when we think about what success looks like from our perspective, we think if companies are calling us for support on things that have absolutely nothing to do with capital, then we'll know we've done a good job. And that's where we're spending a hell of a lot of our mind share on building out a platform to really help companies get from A to B. And of course, capital is a big part of that, but we think it's, table stakes to a certain extent. So stay tuned as to what kind of interesting stuff we have in the pipeline.
I absolutely love that. Before we wrap things up, we always ask our guests for their fast favorites, where I list off 5 categories. You name your favorite of each. So let's start with you, Anthony, and then we'll finish off with Peter. So Anthony, what's your favorite podcast?
Favorite podcast is called This Is Actually Happening by Wondery. It's really cool. It's just folks retelling really crazy stuff that's happened to them.
Got to check that out. Okay. Favorite newsletter or blog?
Favorite newsletter or blog? I got to go with Visual Capitalist.
That's a good one. Favorite tech gadget?
Or a Ring. I think it's awesome.
Nice. Favorite new trend?
I hate to admit it, but I am hooked on TikTok. Absolutely love that thing.
TikTok. Okay. Guilty pleasure. And last but not least, your favorite book?
Favorite book, The Federalist Papers. I swear by it, and I really wish it was required readings in schools everywhere.
That definitely should be required reading in schools. Good ones. All right, let's move over to you, Peter. Favorite podcast?
I love innovative podcasts. So Masters of Scale and American Innovators.
That's a good one. Favorite newsletter or blog?
Stat News.
Favorite tech gadget?
My Apple Watch. I got sick 2 years ago, had a long road to recovery coming back from Guillain-Barré, where I was completely paralyzed, wanted to track everything that I did on my road back to recovery. My Apple Watch absolutely enabled that.
Wow, that's incredible. Favorite new trend?
Raising a fund in my pajamas. No, raising it in my shorts, actually. That was even better. That's the truer statement. Actually, I love work-life balance now. Our team's been incredibly productive. In this time, I'm looking forward to having the team, spend more time back in the office, so we have more connectivity and more, mentorship. But I actually love kind of how some of this has worked out. So I love that connectivity.
Completely agree. And last but not least, your favorite book?
A book that was transformative that I read, when I was in university was Atlas Shrugged by Ayn Rand.
Oh, wow.
I was an all life sciences guy. I read that book and it changed my whole view on being a commercial guy.
Oh my God, that's amazing.
Hey, I've mellowed.
Hey, we have an Ayn Rand quote in our pitch deck that we say, money will never replace you as a driver; it will just get you there faster. So as a VC fund, having an Ayn Rand quote, it's total opposite, but it works for us too. So awesome! Thanks for joining us in the tank today, Anthony and Peter, to discuss why Canadian LPs are starting to wake up to the biotech industry with Anthony Mouchantaf from RBCx and Peter van der Velden from Lumira Ventures.
Thanks, Matt. This was great. Really enjoyed it.
Thanks, guys.
Thanks for listening to another episode of Tank Talks. To learn more about this episode, be sure to go to Apple Podcast or Spotify to find more detailed notes on this episode or to check out previous episodes. Also, if you enjoyed this episode, please leave us a review and a rating, as it helps us out a lot. and hit that subscribe button so you can get notified when new episodes come out. Finally, make sure to give me a follow on Twitter @MattyBCohen or @Tank Talk Podcast to stay up to date on new episodes or to be a guest on our show. Till next time,